Yes, I think the markets are clamoring for liquidity. They want a signal from the Fed that they are definitely gonna accommodate this year. That expectation of accommodation has been decreasing in the last few months, and that's why I think it's a D-Day for the Fed today. Wednesday, May 1st, 2024, Maneco 64, home of alternative economics and contrarian views. So today will be D-Day for the chairman of the Federal Reserve and his pals at the FOMC. And why D-Day? Well, because I think the markets, the economy, the banking system, they're all flashing warning signs. I don't want to say they're teetering on the brink of a major crisis, but things don't look good. And we had some economic data yesterday and also recently confirming that. And I'm also going to reference Rafi Farber's Endgame Investor to quickly look at what's happening in terms of the banking system. I know there's a small bank, Republic First or First Republic, forgot the name, that went bust last Friday. It wasn't a huge bank, but it could also be, another omen for the whole banking sector, especially as bond yields start rising again, which is not really what the Fed nor the U.S. Treasury wants to see. So before we look a little deeper into this, just wanted to ask you if you enjoy my videos and you haven't subscribed to the channel yet, make sure you do. Make sure you hit the little like button if you enjoy my videos as well. And yes, share it far and wide. Hit the little notification bell to be notified of all my new videos. I make a video every day, and sometimes I post more than one video like I did yesterday. I did a really interesting interview with a young analyst from the UK called Ted Butler. Yes, it's not the older Ted Butler, but he's a sound money proponent, which is really encouraging to see young people get into that kind of field. And he's not a sound money proponent for cryptos, but for gold and silver. So I'm going to put the link to that interview in the description and up in the cards if you haven't seen it. So, back to the Fed, and it seems just like yesterday they had their previous meeting. They have it, I think it was in March sometime. They have it every 6 weeks. And at the time I noted that one of the most important things that Powell said at his press conference, and by the way, the announcement is at 2 p.m. Eastern. And then the press conference starts 30 minutes later. But Powell said something about the balance sheet, or the QT, that they're going to slow down or taper the QT, i.e. they're going to slow down the amount of bonds that they let run off from their balance sheet, be it by not reinvesting the proceeds or even selling it. And I think that's going to be important to listen out for today, what he's going to say about the balance sheet, because I think things are getting worse in terms of the yield curve. And by that, I mean the bond vigilantes out there, which used to be something in the 70s and 80s and up until the early 90s was something that people spoke a lot about. And what are the bond vigilantes? Well, they're investors in bonds that punish the bond market, i.e. they sell a lot of bonds when the government runs big deficits and the debt is going up. Of course, bond vigilantes, they almost went extinct since around the mid-90s, but I think they're back. And there's another kind of bond vigilante that we didn't have back then. And I think that's the Johnny Foreigner, or the foreigners bond vigilantes, and especially from the global south, from China and the BRICS. And it's not just political or geopolitical that the bond vigilantes are acting right now, i.e. getting rid of treasuries. It's also to do with the finances. These people that run these countries, their treasuries, they're not stupid. They can see that the US is abusing its privilege of having the global reserve currency by printing trillions upon trillions, by deficit spending, by getting the debt up to really crazy levels, 1 trillion every 100 days increase. So what's the Fed to do? Even Janet Yellen yesterday said she was worried about the deficit spending. They had to do something about it. Up until last week, she said it wasn't a problem because the real rate on treasuries was only 1%. So what's changed, Janet? Well, I think Janet Yellen can see that bond yields are on the cusp of rising a lot more. And that's why I think we're starting to see banks get in trouble, like we saw last Friday with Republic First. I think it's a small bank from Dallas. And the other thing that I told you in the beginning of the podcast, or my video here, is that bank deposits, according to Rafi Farber here, they're being drawn down. And I'm just going to reference Rafi's Endgame Investor. This is what he says. Second biggest drawdown in bank deposits ever last week. This is interesting. He says the money supply is about to seriously contract. Deposits on a non-seasonally adjusted basis were down $258.6 billion last week, which is the second largest weekly contraction ever. The only large drawdown was the week of regional banking crisis last year. See the red circle above of the weekly change in bank deposits on a seasonally adjusted basis. And he says, Rafi, I don't know what that means exactly, since seasonally adjusted dollars don't exist. Deposits are down on a weekly basis, the most since September 2001. Well, what happened in September 2001? I think you all know. And he goes on to note that's even more than the regional banking crisis and the 2008 financial crisis. So thanks, Rafi, for noticing these things happening under the hood, or the bonnet, as the English would say. So is it any wonder that we're seeing banks get back into trouble? And the banks, of course, hold a lot of bonds and treasuries. And with yields picking up, it doesn't help. I'm going to show you what happened yesterday to yields. I did a screenshot of the treasury yield curve. You can see that the 2-year yield was up almost 6 basis points, back up above 5%. The 10-year was up 7, almost back up to 4.7. So that's not going to help the unrealized losses for the banks, or the losses that are not unrealized. We saw the FDIC data improve for the fourth, I think it was the fourth quarter of late last year, but I think it's going to get worse. And that's why we're seeing the stock market kind of get into trouble, because we have kind of a stagflationary environment here. And before we look at a very interesting chart of the Nasdaq, just gonna go through some of the numbers that we got yesterday. I know recently we had the first quarter GDP come out, and it was a lot lower than expected at just 1.6%. The the deflator and PCE data were higher than expected. So a lot of people, myself included, were talking about stagflation. And yesterday we had a couple of numbers, or three numbers actually. The first one was the employment cost index. And let me emphasize here that the cost of employing people doesn't cause inflation. It's a symptom of inflation, even though central bankers like to say that it's inflationary, because they don't want to tell you who really creates the inflation, which is themselves. But be as it may, employment cost index for the first quarter, it rose by 1.2%, and it was expected to rise from 0.9 to 1%. So that's the inflation part. It's stagflation there. The other two numbers we got, and I know this because I worked in the markets for over 20 years, and I know how important they are. First one is the Chicago PMI. Yes, that's an important number. And these PMI numbers, once they get below 50, it means that it's contracting. The sector, the purchasing managers index for that sector that they're being surveyed is contracting. So these are hugely negative numbers in terms of the economy, because it was expected to rise from 41.4, which was already below 50, to 44.9, but it dropped to 37.9. That's a horrific number there. And I think the Fed and the FOMC are looking at that. You can be sure of that. And the other one that's really important, and it's all to do with the consumer and how much they're going to borrow and how confident they feel, is the consumer confidence number. So the Conference Board consumer confidence number, and that was expected to rise from 103.1 to 104, but it dropped to 97, and that's why we saw the stock market yesterday come off quite a bit, even though we haven't really come off, as much as I think we can. We had the Dow down 570 points, or 1.5%. S&P dropped 80 points, or about 1.57, and the Nasdaq dropped just over 2%, or 325 points. And with that, I wanted to show you this chart of the Nasdaq, and it's a weekly chart going back quite far, even before, at the beginning of the dot-com bubble, as you can see there, in the mid-90s. And look at the double top we formed. So I wrote here, mother of all double tops, or will the Fed come to the rescue? Yes, I think the markets are clamoring for liquidity. They want a signal from the Fed that they are definitely gonna accommodate this year. That expectation of accommodation has been decreasing in the last few months. And that's why I think it's a D-Day for the Fed today. So it's all on Jay Powell's and the FOMC's court right now. Interesting times. And if you've been insuring yourself and your savings by having assets outside the system, by not having that much debt or any debt at all, by not being leveraged, by living within your means, you should be okay, in my opinion. You just need to sit back and watch what happens. And it could be, we could have fireworks coming very soon. And this is not to talk about what's happening geopolitically. This is just economically and financially. So let's quickly look at where the markets are then this morning. It's just gone past 8 a.m. London time. Gold and silver got hammered quite a bit yesterday. I think it's got to do a little bit with what's coming up later on today from the Fed. I think the most important thing, not just in investing or having gold and silver, is patience. If you've decided your stance and strategy and what you believe in and what you think is going to happen, you need to sit tight and be patient. I think patience is something very undervalued in the investment speculative world. And why is that? Well, because a lot of the fund managers, hedge fund managers, private equity people, bankers, they're all compensated for a very short-term performance, and the people get bogged down with with the time. They want something right now, and I think that doesn't help you have a clear path or strategy. So yeah, patience. Patience is the most important thing in my opinion right now. But be as it may, spot gold is up just over $1 at 22.87. The low has been 22.81, and the high has been 22.93. Just to give you some perspective, we closed the year last year at 2,060. So gold is still way above, its level from last year, and it's comfortably above the breakout around 2130 or 2150, which had been the previous high. A lot of people probably bought gold when it was at 2400 because they had the fear of missing out. All I have to say is that dollar cost averaging, or buying whenever you can, that's the way to do it in my opinion. Silver as well, it's holding above, that key 26 level, which when it broke out about a month ago or so, really got silver, on a upward path that was very quick. I think maybe we're just retesting that breakout. But right now, though, we're up 14 cents at 26.42. The low's been 21 and the high 52. Apart from the Nasdaq, which is down about 0.5%, the rest of the market is pretty much unchanged here, the stock market, the currencies as well. And commodities, yes, they're off a little bit. We're seeing WTI crude trade back to almost 80, and Brent almost back to 85. High-grade copper has come off a little bit. It's down 0.5% at 454. And I saw that cocoa has had a big correction, which is not surprising. We're back around 9,000 after going up to almost 12,000. But also to give you some perspective, cocoa was trading below 3,000 last year. So we're still, 3 times higher. And maybe cocoa has topped, but we'll have to wait and see for that. What about the bond market? Well, it's pretty quiet overnight, waiting for the FOMC. The 10-year yield is unchanged at 469. The 2-year as well is pretty much unchanged at 504. So with that, I'm going to wish you all a very good day. Take care. Bye.